was a continuation of the reopening trade, a lot of optimism on vaccines. And I think we saw the 10-year pull back a little bit. You covered that earlier. I think that's really going to be the driver this year. And I think fears of hyperinflation and interest rates, the 10-year heading towards 2% and staying there, are a bit exaggerated. And I think once investors realize it's a global economy, there are a lot of headwinds against super growth around the world. There's high unemployment still. The U.S. is one of the most aggressive central banks and one of the most aggressive fiscal responses. It's not being mirrored around the world. And I think when people realize we may actually have some slower, steadier growth this year, I think they decided to dip their toe back into stocks.
Are the concerns around inflation warranted when the latest inflation read on PCE, Personal Consumption Expenditures Index, came in well below the Fed's target of 2%?
Well, inflation is going to be dislocated in areas that the pandemic has dramatically hit, like new housing and housing costs and materials and commodities. It has gone up. But what's going to happen with rental prices? There's going to be a decline in areas like that. You also, as I mentioned, when you have high unemployment, you have less wage pressure, and that is going to be a headwind. You also just mentioned how OPEC Plus is going to be meeting again. They have very hard time keeping their production targets and limits. So eventually, there are going to be counterforces to the burst that we just saw in terms of inflation fears. And I think that leveling out is going to prove to be optimistic for stocks.
So you have a stimulus bill continuing to be debated in Washington, retail earnings on deck today with Target and Kohl's, and an unemployment report, jobs report out this Friday. What's your top trade today, Mark?
Well, it really depends if you're one of these aggressive investors that want to be involved in the emerging technologies and the disruptors. And if you are, that's very different than someone who is more for the slower, steadier investment profile. We fall more into the latter. But if we want to be a little more aggressive in that sphere, we really think emerging markets have very good opportunity for investors. They have favorable debt, low government debt overhang, favorable demographics. They don't have the aging populations that we, Europe, and Japan have. And I think that they're going to present investors with significant growth opportunities this year, but well into the future. That's where the growth is. And I think especially in Asia, where they've handled the pandemic well and the economies are rebounding well from this pandemic, could be a good place for investors to park some money.
Shepard Smith here. Thanks for watching CNBC on YouTube.